Good morning and welcome to another Director from the Desk. My name is James Gerrish. I'm the primary contributor here at Market Matters. I wanted to give you a quick run through to start off the week. It's Monday morning about on the 18th of September, just before 7 a.m. and I wanted to run you through some ideas for the week going forward. Today's Direct from the Desk will be a little bit longer than perhaps others have been, but we've got a lot to cover. The markets are pretty exciting at this current stage. I think we're close to some turning points in the market. You can clearly see that this is the ASX on the screen there. We've been trading in a pretty defined range for quite a while now. We're into our 17th week of that very defined range. If I go up here and look at our weekend report, so daily support 56.29 to 56.55 and resistance up at the top of that at 58.36 to 58.10, somewhere in that range. We've obviously been trading here for quite a while, and at some stage we will break out. We've been looking for a breakout. Our preferred scenario is a break to the downside. However, we do note that there has been some strong buying into any weakness on the local market. I wanted to frame this quick update in a couple of short, sharp ways. Market Matters is all about getting the right level of exposure into the right sectors, the right stocks at the right time. So that might seem a little bit of a pie in the sky view on things, but that's what we're attempting to do when we look at markets, when we position in markets, and you've got to set yourself, I guess, a target in markets around what you're going to do. If you're simply going in there and tracking the index, you simply should buy an index fund, and that index fund will go in there and track the index and give you the index return. We're not about that. We're about adding value to the investment process. We're about trying to outperform the index, and by doing that, you've got to have conviction in your calls. So today I want to run through some of our conviction calls in the market at the moment. We talk a lot about seasonality in the market, so I just wanted to start with a quick overview of what we're looking for in terms of seasonality. We talk about on the screen in front of you, you can see the 8-year seasonality of the ASX 200. So that's the typical returns that you see in the month of the broader market over the past 8 years, and then it averages out at the top. So you can clearly see July is a pretty bullish month, average of 4.04%. We go into a soggy period in August. You can clearly see, and this framed a lot of what our thinking was coming into May. May is the weakest month of the year, and we were cautious going into May of this year. Now, May of this year didn't prove to be as negative as perhaps has been in the past, but you've got to frame your thinking around that. So, if history suggests that May is a weak month, then you've got to, have that play into your thinking over that period. Right now we're in August and September, which is a pretty soggy period, but there's some differences in the way sectors perform over this period, and I'll touch on that very shortly. We go into October. Everyone's scared of October, particularly October ending in 1-7, ending in 7, given the 87 crash, etc. But October is typically a strong period for stocks, and it's typically strong the back end of September and October for the banking space. November's weak, and then we go into sort of that December, January bullishness. I want to pull up two charts here in terms of seasonality. CBA, first of all, you can clearly see October, so the back end of September, there's a low put in, or often put in towards the third week in September. Then we have a bullish October, November, December. So that's why we're positioned. That's why, amongst other things, we're very much positioned towards the banking space at this current stage. There's a few other reasons why that plays out. Resources are a little bit more choppy. August, September's weak for resources. October's a strong month for resources, but then you don't have the seasonal strength that we have in the banking space running up into the as banks go into the dividend period in about 6 weeks' time or so. So, one of the big things at the moment in our portfolio is we're reducing our exposure in the miners. So we've had decent positions in BHP. We've got a decent position in alumina. Last week we sold our final 5% out of BHP. We sold 2.5% of it pre-dividend, and 5% post-dividend. We sold the last remaining bit around $27.60. So I think we remain positive overall on the resource space in the longer term. We think that some of the trends in that sector over the longer term, in the instances of what companies are doing in terms of how they're spending their cash, they're improving their returns out of their assets, they're not going out there and blowing money, they're increasing returns to shareholders, etc. So all of those things I think is a positive. But right now, markets have gotten really positive on the resource story. There's been a lot of money piling in there, and I think there's a couple of reasons why they'll struggle in the very near term. Banks, on the other hand, really benefit. I should say, banks have been under the pump in recent times, probably led by CBA, which is probably your proxy in the sector. We own CBA. We've bought it. Our most recent purchase is around $74, but our average price is above where it's trading at now, only slightly so. But banks over this period, seasonally, they're strong. We think US interest rates are going high. We think interest rates here, and when I say that, I'm meaning in terms of what bond markets are doing or bond markets are pricing. So I think US interest rates go high here, and that'll obviously be a positive for the banks. They typically run up into their dividends. They've had a pretty woeful couple of months. CBA's obviously been the worst hit. So the other ones we've got in the portfolio, we've got Westpac in the Platinum portfolio as well. So these are daily charts that I'm showing you there. Overall, I think what we're seeing at the moment is that resources are starting to top out. So you can see from say the likes of BHP, if I put it on the screen here, that resources overall, they look like they're topping out. You can see this pattern on the daily chart over here. Resources look like they're topping out, and banks overall, more broadly, look like they're bottoming out. So if we if we use that sort of thinking at this stage, then we can start constructing a portfolio. So right now we're overweight the banking space, and we're now underweight the resources. We had a time when we were very much overweight the resources and underweight the banks. I want to pull up a chart because I think this is framing what our thinking is at the moment. This is the US 10-year bond yield. It's a weekly chart, so if I go back, it goes over 3 years. If I go back to over 2 years, you can clearly see that it peaked out around 2.63%. Back in December of 2016. Since then, we've had quite a bit play out. Obviously, the US economy the economic data hasn't been as positive as it was back then. The market's got this expectation that the US Fed is not going to raise rates to the extent or at the rate that they're guiding to. And just to give you an idea of what the Fed is guiding to, here is a reasonable chart. I haven't got it on Bloomberg because this is a lot clearer one here. Right now the Fed has the official funds rate at 1.25% over in the US. You can see by Q4 of 2017, this is what markets are pricing in. So this is what futures markets are pricing in at this stage. So by Q4 of this year, the market's pricing in rates of 1.5%, and that doesn't change until second quarter 2018. So right now, out to the second quarter in 2018, the market's only pricing 2 interest rate hikes, and then looking further afield out to 2020, we're at 3%. So right now the market is very much positioned for a gradual uptick in US interest rates. So that's how the market is positioning. So you think about bonds, you think about all the financial instruments that are priced off priced off interest rates, and the US 10-year is typically the benchmark interest rate that you price assets off around the globe. Then we fast forward to what the Fed is saying we're going to get in terms of interest rates. So this is the Fed's dot plot. This is what Fed members believe interest rates will be. 8 projections here. If we fast forward into 2018, the median projection is at 2.125%. in 2018. If you go back to what the market's anticipating in 2018, the market's anticipating 1.5 to 1.75%. So clearly, what the Fed is guiding to and what the market is positioned for are two very different things. We've got some outliers in the Fed here. So we've got one projection at above 3%. We've got the most bearish projection is 0.87%. But the median is 2.25. Then you go out to 2019, the median projection is 3.125%. 2.93% in 2019, which goes to around 3%. So the market is reasonably well positioned out in 2020, but it's this period in the remainder of 2017 and 2018 where the market is mispricing what the Fed is suggesting. Now, I don't think the market will be proven right, and I don't think the Fed will be proven right. I think we'll see somewhere in between. But you've got to be conscious of that fact. Now, what does it mean when interest rates will go higher and the market's not positioned for it? You think about the sectors in the markets that benefit from higher interest rates, and you want to be exposed to those. You think about sectors in the market that struggle in a higher interest rate environment, and you want to be avoiding those typical sectors. I had an email last week with a subscriber over a couple of stocks, and you think about stocks. I'll get this daily chart up of Sydney Airports because it does highlight it pretty succinctly. Interest rates have started to go up, and these stocks are starting to come under pressure. So if you go US 10-year generic bond yield, look at it on the same level. So we've had an uptick on a daily in terms of US interest rates. So they've gone from just above 2.02% up to 2.2%. So that's a reasonable rally in US interest rates. And then you look at a stock like Sydney Airports. I could pull up Transurban if you want to as well, and they've started to be sold. I'll pull up Transurban. So the trends are pretty clear. We had a big rout in these stocks when interest rates at the back end of last year peaked out. They dropped pretty sharply. So if I go back to a weekly chart on Transurban to give you the idea around that, this is when interest rates, that was that period that I showed you before in terms of the US 10-year yield was trading up at above 2.6%. Transurban was trading down at $9.45. So I'll go back to this just to reiterate the point very clearly. On the same time, so this in December of 2000, this is where interest rates were, and that corresponded with Transurban trading at 9.49. So 9.45. So I don't want to be, look, the likes of Transurban, Sydney Airports and other stocks, Westfield is another stock that springs to mind that's been obviously struggling on a few fronts, but higher interest rates, this is a typical yield play. Higher interest rates are negative for it. So let's avoid those areas of the market. So those areas that are negative in terms of higher interest rates. So we're positioned away from the yield trade at the moment. We're starting to position away from the resource space. The only resource holding we've got in the portfolio now is AWC, and we're likely to exit that position if we can get out around the 220 mark, locking in. It was there last week. We didn't want to reduce too much of our resource holdings last week. We sold out of BHP, took a nice 17% profit there, but we're looking to get out of AWC around that 220 mark as well. Our bigger overweight positions, as I said, are in the banks. And the other areas that we think you should be avoiding at this current stage is these high PE stocks. So stocks that are trading on high multiples struggle as interest rates start to go higher. So if you think about Ramsay as one of the stocks we've written about in recent times that is likely to struggle as rates go higher. Ramsay trades on a PE in the 20s, etc. And the other thing that I'd caution around Ramsay is that the majority of brokers out there remain positive. I'll just open and cancel that. Remain positive on Ramsay. So if you think about, I'll bring up the quick analyst expectations on Ramsay. So the consensus price target in Ramsay is $74.52. So that's a 19.8% upside in Ramsay. So right now the market hasn't rolled over in terms of Ramsay. We've got 5 buys, 6 holds, and only 1 sell. We've got 1 sell now in Ramsay. We haven't seen that in quite a while. So when you think about those high PE stocks, higher interest rates are a negative for high PE stocks. Higher interest rates are positive for the banks. Higher interest rates are neutral for resources. If higher interest rates are reflective of increasing or improving global growth, then that's obviously going to be a positive for resource stocks. I think what will happen is dollar index spot. So I think what will happen is these rising interest rate expectations over in the US. So we start to see interest rates tick higher in the US. That's probably going to drag the US dollar up. So on the screen in front of you, you've got the US dollar index, which tracks the US dollar against a basket of its major trading partners. We were negative on this. We're calling it lower from that 102 area, 103 area, and it's come back down to our target around 91. So if US interest rate expectations are going higher, then that should drag the dollar higher, and that'll be a negative for commodities in the very short term, dependent upon the numbers we get in terms of global economic growth. I want to flick over to the other area of the market that we're overweight in at the moment. So in our portfolios, we're overweight financials, and we're overweight insurance stocks. So insurance stocks are obviously fit into the financial space, but the insurance companies have been very much on the nose in recent times. So insurance stocks benefit. Well, there's a couple of things that play into insurance stocks' earnings. Firstly, they've obviously got to have a favourable backdrop in terms of earnings, so premiums have got to be rising, and that's not the case with QBE at the moment. Global commercial premiums are still falling, but they're falling at a lower rate than they have done in many years. So the falls in global commercial premiums are starting to abate. The trends are starting to be positive, and QBE, we've got this stock from around these current levels. We bought it back. We bought it back in the end of 2016. So we were sitting on a very nice big profit out of QBE. Unfortunately, that's been wiped out. Hindsight would say we should have sold that stock, and clearly we should have. We didn't. We're now back to where we bought the stock, but we remain positive here. Patience will be required in terms of the insurance space, but the thematics underpinning future earnings of these companies, I think, are positive. So I touched on one, commercial insurance premiums. So whether that is global commercial premiums, which are really important for QBE, or in terms of Suncorp, domestic insurance premiums, which are actually rising here in Australia. So Suncorp has got a really strong backdrop of rising premiums here in Australia. The other thing that obviously impacts these guys is around interest rates. They obviously invest your insurance premiums, so it helps them if interest rates are going higher. That's obviously going to be a benefit for the insurance stocks. And as in QBE's instance, they earn a lot of their earnings overseas, so a high US dollar. So the US dollar has been weak recently. A high US dollar is going to be really supportive of QBE's earnings. One of the things that is important for both is excess capital on their balance sheets. So right now, an insurance company sets aside money to pay out claims into the future. If they've set aside too much money, they get some reserve releases coming into their P&L. We've seen that in terms of Suncorp. We've seen that in terms of IAG. We've seen it to a lesser extent in terms of QBE. They had some reserve releases. Then they had an issue in their emerging markets business where they had under-reserved for the claims that were made there, and they took a hit on that, and that's why the stock got sold down. So I guess I want to leave you with a couple of important points in terms of our portfolio positioning at the moment. As I said from the start of the presentation, Market Matters is all about right exposure or right level of exposure. So what I mean by that is around having the right levels of cash. We don't manage a model fictitious portfolio. We manage a real portfolio. So cash is really important to us. So we can only go out there and buy security into weakness if we've got the available cash reserves there, or if we want to sell one of our existing stocks to buy a new opportunity or take up an opportunity. So we're all about the right level of exposure in the right sectors, and then holding the right stocks at the right time. As I said earlier, it's a fairly optimistic view to have, but we're active managers in the market. We're active investors in the market. We're not necessarily traders, but we do rotate into sectors that are in favour or out of favour at a particular time. So we're likely to be on the sell side of areas of the market that have been strong, and we're likely to be buyers into areas of the market that have been weak if the near-term outlook for those areas are improving or are turning, and the market is negative on a particular sector. So right now, the market is bullish on the resource plays. There's no doubt about it. They're bullish resources. They're negative banks. We think the time is to take profits in the resource space and buy into the weakness in the banking space. Seasonality supports us. The expectation around higher interest rates supports us. I think the negative headlines around banks in the last little while I think are overplayed. From a relative valuation perspective, banks they're not super cheap, but they're cheap relative to what the market and some of these other yield plays are trading at the moment. We're negative the yield stocks. So those stocks that are exposed to higher rates, we're negative. So Transurbans, Sydney airports, etc. We're negative on those stocks, and we're negative on the high PE stocks. So you've got to be looking for value in this market, is what I'd be suggesting. And I'll grab a chart just back of the ASX 200 to finish things off on this direct from the desk. Again, this frustrating range continues to play out. 58.36. 56.29 on the downside. We're likely to open up about 16 points on the market this morning. But again, we're looking for a catalyst. North Korea, nuclear missiles, etc., have not been the catalyst, which is surprising to me. I would have thought that the market might react more negatively to it. We've got high cash levels in the portfolio, in both portfolios at this stage. We're looking for opportunities into market weakness. We think the market goes probably 55.50, 5,500 before it goes higher, but we are conscious of the fact that the market has been resilient in the face of a lot of bad news. I hope that helps. I'll be back with you with another direct from the desk, perhaps later on in the week, and I hope you enjoy the service. Bye for now.